Hello and welcome. We recognize what a unique time this is in the world, and thank you for taking a little bit of time to talk to us to listen and participate in this topic. My name is Ryan Agee. I'm the Senior Director of Planned Giving here at the Foundation. And the Foundation's the fundraising arm for Swedish healthcare systems. We're the largest nonprofit healthcare system in Washington State, based in Seattle. I really view my job as to help and listen and work with supporters in the area as a philanthropic investment advisor to think about charitable strategies that really work for us, of course, as Swedish, but that make sense for your family and your planning as well. Tell you a little bit about how we're going to spend our time together today. We're going to welcome Jonathan Gudema from Planned Giving Advisors to discuss some current tax policies, some future legislation that we might want to keep our eye on that could have an effect on our planning, as well as some tried and true estate planning strategies and charitable strategies that somebody can use, we can all use every day. And lastly, I just want to thank all of our supporters and donors, from our CEO down, all of our caregivers. We really wouldn't be able to accomplish all the things that we do every day without your help. So Jonathan, welcome. Please tell us a little bit about yourself and how you came to help families and organizations.
Okay, thank you, Ryan. It's a pleasure to be involved with you guys and to give this talk. I've been a lawyer since 1994, but my career has been split up between working with as a regular attorney, normal law practice. But in 1998, I moved more into work with nonprofits and working with donors on estate planning type gifts. And about 15 years ago, I also started to work with a family wealth office. So right now I run a consulting business called Planned Giving Advisors, where I work with nonprofits and helping their planned giving programs and helping donors fulfill their charitable estate planning goals. And also I work as in-house counsel to a family wealth office. So I have my hands in both working in nonprofits and helping fundraising programs, but also I spend quite a bit of time on estates and trusts. And this has really led me for many years, really since around 2001, to start following legislation, how it affects individuals in terms of planning. And I would have to say that the last couple of months for me have been, this is probably potentially the biggest amount of changes and potentially no changes. So I've been following this very closely. And so I hope you'll get a lot out of the hearing about what might be changing and what might not be changing, but mainly also some of the basic planning ideas. So let's start the presentation, and Ryan will also be helping out during the presentation. So we're going to cover a couple topics. We're not going to try to just give you a basic overview. I wanted to start off quickly with taxes, what's the situation, what's the current state of taxes on income tax, appreciated assets, capital gains, and gift and estate tax, and some other related items. And we're gonna do a little review of what's going on with the infrastructure bill and all the proposals involved in that, and involving personal tax planning. And there's quite a bit of potential changes, none of which may happen, some of which may happen, but it's worthwhile to have a little bit of a view of what potentially might be happening, and at least be ready in case some big changes happen, which we might find out any day now. But what I really want to focus on is the realistic issues that you might be facing, realistic options in terms of protecting your family wealth, your family assets. And of course, I want to always finish up with estate planning basics. I mean, my practice, again, is split between a family wealth office and working nonprofits, but I also have a small practice in terms of just working with normal individuals and basics of estate planning. So I think that'll probably be the most practical for a lot of people on the call. But again, we will address the major issues of the day, which are potential tax law changes, which are pretty significant. Okay, so what's the current state of taxes? Again, this is just a very broad overview. I'll try my best to define things and work through this slowly, but keep in mind that we have an hour total, and this we have to cover some ground. So, okay, so basically, in terms of this income tax, the tax brackets currently are between 10 and 37%. The standard deduction was increased a couple of years ago. It's up to $12,400 per person. Again, it comes out differently depending if you're filing individually, married couple gets double, or head of household. SALT, the state and local tax deduction has been capped at $10,000. That affects people in higher state tax jurisdictions like New Jersey and New York, where I practice and live. Other places where there's no state income tax, it might not be such a big issue. The capital gains rates, they range from 0, 15, and at a certain point it bumps up to 18.8 and then 23.8. But I'll describe that when we get to. We have a chart coming up which will show you where those different capital gains and dividends rates kick in. And the federal state tax, we'll talk a little more about it, but the federal state tax has, what I say here is that they don't start until 11.7 million per person. That's an exemption. Again, we'll just show you that the progression of how that exemption got to where it is. The top rate is 40%. Again, so that's been in place since 2018. And there's a standard, the annual free gifts is actually called the annual gift tax exclusion. This is basically an amount that you can give to as many people as you want without having to file anything. Just it's called these free gifts, and there's no limit on numbers of recipients. It's a very basic but standard estate planning tool. I can tell you that the family wealth office I work for, a very wealthy family, obviously, they utilize these $15,000 per person. I guess husband and wife each give 15, so it comes out to about 30,000. They almost always fulfilled this every year. So even though it sounds like a pretty basic one, it's something that typical people could be doing if they're worried about any concern about estate taxes. And then there's some issue of what's called the step up in basis. This is essentially if once somebody passes away, all capital gains and any assets they own are wiped out. They are essentially get what's called a step up in basis. The basis is really purchase price. Again, we'll talk a little bit more about that in a couple slides. But essentially, this has been standard in the United States for sure up since 1970. There was a year or two where it may have been changed and they retroactively undid it. So it's been the standard. And again, the reason I'm mentioning it is that it's something that's being discussed to be changed. So I want to make sure you have an idea of what that is and what the changes might be. Just a couple of pretty new things. Something called the stretch IRA. If you ever did any sophisticated IRA planning, one of the standard planning opportunities that attorneys and others were advising clients was that if they have very large IRAs and they want their children or grandchildren to inherit them, they could stretch out the payments over the life expectancy of the person inheriting the IRA. So a grandchild, for example, could inherit an IRA and not have to take all the money out right away. It could have 40, 50 years or more to withdraw the money, all the while still growing tax-free, only taxed as the money is withdrawn. But that plan is gone. So they basically, now it's basically a 10-year rule. So just so you know, if you had a stretch IRA plan, and there are very complex ways to set these things up. And so if you had done some sophisticated IRA planning with your attorney and you didn't know that they changed the law, it's something you should know. It has been changed. And now required minimum distributions for qualified retirement accounts, IRAs, 401ks, 403bs, other qualified retirement accounts. The required minimum distributions don't start until age 72. And actually, if you continue working past age 72, you can actually add money to your IRA. It's only if you have earned income. So that's a new rule, again, that came in the Secure Act on January 1st, 2020. Okay, so let's define federal tax on appreciated assets. Again, I just want to get some definitions, and then this will help us understand what the proposed changes are being made. Capital gains, capital assets, cost basis, step up in basis. Again, I've already started to define them. Now, capital asset, that is a piece of property, significant property, such as a home, stocks, bonds, it could be art or collectibles. Again, these are assets that if you hold it for more than a year, you get a special tax on the profits you might make if you sell it. So that's what's called the capital gain. It's basically the profits on the sale of capital asset. Now, the taxation only happens when it's realized. I'm mentioning this because there is some significant proposals that could be included in the infrastructure, the large infrastructure deal that's being discussed right now in the media. That if you're watching news, it's a very big story. If the larger 3.5 trillion infrastructure deal is done, they may start taxing unrealized gains. So I'll have to define that when I get to it. But again, so this is the big issue. Up until last 30, 40 years, capital gains has only been taxed when realized, and there are some exceptions to that, but essentially that's been the rule. Again, when the asset is sold, you pay the capital gain. Now, the cost basis I mentioned already, that is basically the original value, purchase price, if you will, of the asset. And then it gets adjusted, could be adjusted for stock splits, dividends, return of capital, capital distributions, capital improvements. So your cost basis is the point where we determine how much you're going to pay in capital gains. So again, it may be adjusted over the original purchase price. If, for example, if you inherited, we'll get to that. We'll get to this point. I want to mention about inheriting assets that had grown in value. But essentially, one other point here, in terms of capital gains, if you sell a capital asset that's appreciated within 12 months, you don't get that lower capital gains rate. You get the ordinary income, the higher rates. So that's something to note. And lastly, capital gains rates have been significantly lower than ordinary income tax rates. The reason being is that we want to encourage, there's sort of good policy to encourage people to maintain ownership over certain types of assets and houses and stocks and things like that. So that's been the basic policy. And then lastly, and I started mentioning this already, the step up in basis. So when somebody passes away and heirs inherit something, for example, a house, if you inherit a house from a parent, for example, or anybody really, at this point, you would receive the house with what's called a stepped up basis, basically the fair market value of the house on the date of death. That would become the recipient's basis for determining capital gains whenever you sell it. Essentially, what the government has been doing with this is that there's an estate tax. So the estate could be facing estate taxes, but they're going to waive the ability to go after the capital gains. The state tax rates have always been higher than the capital gains rates. So, one way or another, it would work out. But again, this is something I'm only discussing this because this may get changed. And this is something that's out there in terms of the infrastructure deal. Okay, so here's the income and capital gains rate chart. This sort of helps us understand where this all fits in. So just look at the single filers. That's the easiest way to look at it. So you pay these different rates. Now, just note, by the way, when you have, let's say you're earning, let's say $165,000 in income. Now that's taxable income. That's after deductions and stuff. So let's say your taxable income is $165,000. So you don't pay 24% on the entire $165,000. You pay 10% on the first $9,950, 12% up until $40,525. Do you understand what I'm saying? It's graduated. Now, if you had that $165,000 of taxable income, you would have to pay the 24% bracket only on the difference between $165,000 minus this number, which is basically $75 taxable, 24% rate. So I like to mention this because people get very nervous about taking. Let's say you decide to take extra money out of your IRA, and there are reasons why you might want to do that instead of taking the required minimum distributions. You let's say it goes into a higher bracket. Let's say you end up in the 32% bracket. I'm sorry, yeah. So if you went over 164,000, you would actually enter the 32% bracket. So if you enter the 32% bracket, you'd only be paying that 32% on income above that level, 164,000. Now, just take a note here: the capital gains rates. This is the brackets for if your earnings up to $40,000 $1,400, that you have a zero capital gains rate. If you earn between the next group, 15, it's a 15% group. Now, if you earn that's up to $200,000. Now, if there's a little star there, if your AGI is a little different than slight difference than the adjusted gross income, that's what it stands for. A little difference between the adjusted gross income and your taxable income. So I put the star there. So when your adjusted gross income hits $200,000, which is usually a little higher than your taxable income. When you hit that level, you get hit with your capital gains rate jumps to 18.8% because there's the 3.8% Obamacare surtax, which is still in effect, even though there was a change in tax law 3 years ago. They didn't do anything to this. So your capital gains rate may total at 18.8%. And then if you hit the highest level of capital gains, which is over 445,850, if that's your taxable income, then you join the higher capital gains rate. It's technically 20%, but you have to still add in that 3.8%. So that's where you get. Now, I hope I didn't throw this at you too quickly. I just want you to note that there may be some significant changes when it comes to taxes, income taxes, and capital gains. For example, as we're going to talk about in a minute, if, as proposed by, the administration has proposed taxing anybody earning over $1 million. Again, I don't know if it's $1 million adjusted gross income or taxable income, but let's just say you're earning over $1 million of taxable income. They want to increase your ordinary income rate to, if you want to increase the top ordinary income rate to 39.6, go back to where it was back in 2018, and then they want to actually tax your capital gains at that same rate. So I had another chart that could have showed you, if that came to effect, then you would have 43.4% would be a top capital gains rate, and top income tax rate would be 39.6. But again, we're going to talk about that in a second. These are all proposals as part of the infrastructure deal, because the large infrastructure deal that's being discussed now needs revenue to pay for it. And that's where all the potential tax increases are being discussed. And back to just finally, federal tax on gift in the states. So the estate tax, the system of the estate tax in the United States is there's a tax when there's an estate tax that is applied only when your estate exceeds a certain exclusion amount. It's a lifetime exclusion amount, and we'll discuss what that is in a second. Now, there is also a gift tax. So the gift tax is applied if somebody makes gifts beyond the lifetime exclusion. Again, this is for federal. I'm going to ask Ryan to discuss by the next slide. I'm going to have him discuss a little bit about Washington state level gift and estate tax. But so the gift tax is basically linked to the estate tax on the federal level. Essentially, you can use it while you're alive, or you can use it after you pass away. That's what's called the unified transfer tax. The reason it's unified is that, again, they didn't want to give an advantage for individuals to make gifts either alive or at death. They wanted to sort of make it an even playing field. So you can utilize your exemption amount during your life, or you could wait to use it in your estate. Again, you'd have no federal estate tax. Again, Ryan will discuss the state level. There is some state level taxes that could apply. And so that's that lifetime exemption. That's what I call it. That's really, or exclusion amount, but it's really a lifetime exemption. So this actually amount, the current lifetime exemption allows you to make gifts to children or grandchildren, which is basically called generation skipping. There's special, very onerous taxes on generation skipping, but the exemption also applies to gifts to other generations. Now, the IRS, when I say here, the IRS keeps track of your lifetime giving. They only keep track of what you report. And the way you report it is your accountant. You tell your accountant that you've made gifts, and they're supposed to file, along with your income tax return, you're supposed to file what's called a gift tax return. I say supposed to because I actually have a feeling that a lot of times these things never get filed. Again, that's part of what I do for this family wealth office. We're trying to catch up on 20 some odd years of missed gift tax filings. It's actually pretty complex. Okay, and then again, I mentioned, Ray, the annual gift tax exclusion. Again, I don't need to go back into that. That's just straight gifts. It's currently 15,000 per person. Husband and wife get double it, so you get 30,000. And it's a very simple but standard way to reduce some of your estate. Now, I just wanted to show you sort of the ups and downs of the estate tax. So back early in my legal career, it was the estate and gift tax exemption. They were unified at $600,000. So, and the maximum estate tax rate was 55%, which is pretty high. And even though obviously $600,000 in 1997 was quite a bit of money compared to as it is today, but in any case, still it was a pretty. The state tax was definitely in ready for some increasing the exemption. So back in 2000, starting in 2001 actually, and through 2010, Bush had the Bush 2 presidency had basically made some changes. So they started first. They knocked up to $1 million the exemption, both on estate and gift, and then by 2009, the estate tax exemption was $3.5 million per person. But the gift tax exemption stopped at $1 million. So if you made a gift, if you gave up to $1 million, you wouldn't be paying anything. If you gave over $1 million, you'd have to actually pay some taxes. But if you waited to give it in your estate, you wouldn't be paying until you exceeded $3.5 million. And you can see the tax rate was going down. Between 2011 and 2017, particularly with the Obama administration, there was some compromise, and they ended up coming up with a $5 million exemption, both for estate and gift taxes. And the maximum tax rate was 35 and or 40%. I forgot that it just sort of graduated rate, but the maximum rate was 40%. The last couple of years, though, since 2018, they basically doubled that. So the current estate tax, every single one of us could give away up to $11.7 million. Husband and wife, you can double it. That would take you to $23.4 million with a maximum rate of 40%. So obviously, it's a huge difference between over the last 25 years, back to 1997. Ryan, I want you to tell a little bit about just make sure people know that there is a state level estate and gift or gift tax in Washington.
Yeah, sure. Thanks, Jonathan. I hope you guys are hanging in there for the tax talk. It's thrilling stuff, but it does have an impact. As you can see, we're at a pretty highest in history level of exemption and pretty low taxes. And that's why it's likely that things will change, whether it's this year or coming forward. Another wrinkle is Washington State, in addition to your federal estate tax, if you had over 11.7, they're going to tax you as well. So Washington State's threshold is 2.2 million for an individual. So anything over 2.2 million or 4.4 million as a couple could be taxed up to 20%, 10 to 20% graduated based on the size of the estate. There are some tax strategies that I encourage you to talk to your advisors, some ways to mitigate some of that tax. You can use your federal exemption to help get your estate lower and all these things. But anyway, just another wrinkle to know that Washington State has an additional estate tax. So just wanted to throw that out there. Thanks, Jonathan.
Yeah, no problem. So yeah, and I noted that's the Washington State tax is a little higher than New York's, which is kind of surprising. But then he reminded me that New York has a state income tax of up to 10%. So we're paying a little more here anyway. So here's getting to the proposal. So this is the chart that gives you a good vision of where things have gone in terms of state and gift tax. But the proposals right now, and again, we don't know what will end up happening if they pass a larger infrastructure deal. We'll only find out after the fact what they eventually agree on. But what they've proposed is going back to the 2009 levels, 3.5 million per person exemption and a $1 million gift tax exemption. And there's also included in the proposals is a billionaire estate tax of up to 65%. So again, I don't know how it grades up there, but once an estate is at the $1 billion mark, they're looking at a 65% estate tax. There are a couple other things reason I define these things is I want to let you know, and I'll go into a little more. They're possibly changing the step up in basis at death. That's a pretty big change because it's basically been a standard for so many years, for more than 50 years. Taxing unrealized capital gains on certain transfers. Again, those types of transfers are typically estate planning transfers to trusts, things like that. They may want to start taxing those transfers, and also changes to the annual gift exclusion. Again, I'm going to describe that in a second. But before we get to the potential proposals, just two quick points here. There's been some COVID relief bills that affect personal planning, one of which is if you're no longer an itemizer, because basically 90% of tax filers in America are no longer itemizers. That's not a bad thing. It's just because the exemption amount, it's 12. You have 12. Each person has $12,400 per. $12,400 per person. So you can double it to over 24,000. And if your deductions don't exceed that amount, you just take the standard deduction. And so if you're taking a standard deduction, essentially your charitable giving is still worthwhile. I mean, charitable giving hasn't gone down because of this, but you don't get any tax benefits. But last year and now 2020, now 2021, they're testing giving people opportunity to take what's called a non-itemizer charitable deduction. It's only up to $600 for those married filing jointly, and all others get $300. But it is something. It is a deduction. So if you're not an itemizer, you should still save some of your receipts. Make sure you take advantage of this small deduction. Another interesting point is in 2020, now 2021, they're allowing individuals to deduct charitable deduction up to 100% of their AGI. Again, the AGI is not the taxable income. It's the after the first level of deductions on your tax return, you come up with what's called your adjusted gross income. Normally, you cannot deduct in any 1 year more than 60% of your AGI for cash gifts, and you can't go more than 30% for appreciated assets like stock. Except for in 2021, you can actually go as high as 100% of your AGI, which is kind of interesting. But that only applies to cash gifts. So if that applies to you, you want to, just want to know. Sometimes accountants aren't always familiar with this, and I actually had to advise some accountants. Oh, by the way, this client of yours can actually take advantage of this. So it's something it's worthwhile to mention. If you're making very large gifts, particularly cash gifts, and actually it may change your planning because you may. If you're thinking about a large gift, you say, wow, if I give cash, I can take an even larger deduction this year. Now, by the way, if you go over that ceiling, if you donate more than, in a regular year, more than 60% of your AGI, you can't deduct it. It does carry over for another potential 5 years. So you don't lose a deduction if you exceed the limits. You can't take it in that 1 year. Okay, so just really one slide on the infrastructure bill. Part of it is just really we're not going to know what's going to be in it if it gets passed, and that's a big if. It may in fact not get passed. This is the second, the two parts of the infrastructure deal. The real infrastructure deal, the compromise bill, which was passed by the Senate already, which is supposed to come up for a vote in the House actually today, but I think they delayed it. That does not have tax increases in it. For the most part, it's larger, $3.5 trillion infrastructure package that has all the tax increases. And let's take a quick look at the things that are being proposed here. Number one, this was in the campaign. President Biden had talked all along about moving up the highest level income tax bracket to 39.6%. It's to be seen where that'll start. It could start at 400,000 people earning over 400,000. Could start at people earning over 500-something thousand. But essentially, they had promised that they want to return the highest bracket level to pre-2018 level. This is the new thing. They want to tax capital gains and qualified dividends at the highest ordinary rate, the new one, which would be 39.6% on anybody earning over $1 million. Again, how this actually plays out, we would have to see. But that would knock people in this who earning over $1 million would be subject to a 43.4% capital gains and a rate on capital gains and on dividends. So that could have a significant planning impact. We mentioned already they're thinking about dropping the estate tax exemption, that exclusion amount, to $3.95 million per person for estate and $1 million per person. Now, there are other proposals out there. I just saw something today said they were thinking about just cutting it in half, the 11.7 down to whatever, basically 6 per person. So this is a pretty big proposal. They're looking about, I was kind of surprised, but they're looking about capping, not allowing the free annual gift exclusion gifts, that 15,000 unlimited giving power. They want to limit it to 10,000 per recipient, per donee, and a 20,000 per person cap. But essentially what that would mean is that if you gave more than this amount, you'd have to file it. You'd have to let in a gift tax return. So essentially, you wouldn't have to pay taxes, but you would have to start utilizing your lifetime exemption. So it's a pretty significant change, actually. The other one is kind of startling potential change. Again, these are all things that in the end of the day, when they do a large bill, they do have to make, particularly a reconciliation bill, which is what it means is, it basically means that they have, whatever it has to add up, money, it has to be enough revenue to cover the cost, and it can only go for 10 years. There's a bunch of rules when it comes to reconciliation bills, and that's what the infrastructure deal most likely would come through. So their proposal is the tax capital gains at death for anybody who passed away with over $1 million of gains in their estate. So the first $1 million of gain would be step up basis, like we've seen the last 50 years. But then beyond that, there'd be a capital gain. There's a bunch of rules, but I'm not going to get into the rules because, again, this is things that may or may not happen. Again, once it does happen, obviously, planners and people like Ryan and myself will be out there trying to make sure everybody knows what the new rules are. They may also tax capital gains on unrealized gains for transfers with over $100,000 gain. That's really aimed at what I do at this Family Wealth office, to be honest. That's really aimed at large trust transfers, which are at this point we don't pay. We do a lot of moving of trusts. I've worked on over $500 million of successful wealth transfers in the last 3 or 4 years. Very significant amount. All of which is basically zero basis stock, and therefore they would be taxing. That we're talking about $100 to $200 million of taxes that they would have to pay on those transfers. So it's very, very significant for very large estates and estate planning situations. And so that's what I'm worried about. You may not be worried about it, but I don't know how I deal with the fallout when it comes to this one family project I'm working on. And then lastly, and I'm not going to, again, the details are not worth going into too much, but they're looking at and see very significant changes to dynasty trusts and other sophisticated trusts and other sophisticated plans. But basically, I read here I call these end runs around the estate tax. Like I said, I've worked on over $500 million in successful wealth transfers. We have not paid a penny of taxes, and all the money at the end of the day all the stock would end up in dynasty trusts. And if we ever sold things and had to pay capital gains, it would still be in jurisdictions where there'd be no state level taxes. But all the plans that we've all the different tricks I've worked on would be out the window. So,
hey, Jonathan.
Yes.
Yeah, we have a question coming in. Does the tax on unrealized gain apply to charitable trusts, like charitable or managed trusts?
So that's a good question, and the answer is that in the earlier proposals, it looked like it did, and that would be something that the charitable community would immediately move to fix, because it would essentially make you set up a charitable trust, and you have to pay capital gain. You could potentially have to pay capital gains on it. So that's something that I think that if it gets included, there would probably be an immediate pressure to fix it, because why would you want to, penalize charitable giving?
Hopefully unlikely box, I think.
Yeah, I would say not likely to happen, but it was in there, and there were some nonprofit groups that gotten together to try to start lobbying. But at this point, I don't think there's any possible way to lobby. It's essentially, it's Congress trying to hammer out something. So we'll have to find out. Once they finish it, then we can try to start lobbying. But thank you for the question. Okay, so that was just an overview. I think the main message of those changes is really that you do have to be on the watch for these potential changes. You do have to follow this, and if a larger infrastructure bill is passed, you will likely want to talk to your estate planning attorney, and that would be get to our conclusions. But let's look at what's like realistic at stake and some options to consider in terms of protecting your family wealth, your family assets. Well, I would definitely say that the federal and state and gift tax exemption, that one is, that's high on the target list. So that's likely if a larger infrastructure bill is passed, that will likely include a reduction of that exemption. And I'll tell you a couple slides what to do about that. Definitely higher income tax rates for higher earners. Again, that's been promised. The higher capital gains and dividends rates for the higher earners. Again, if that affects you, you will definitely want to be following that because it may be significant changes in how you invest and different and how do you react to these changes. The free capital gains step up at death. Now this is, I'm a little concerned about this because it's just in terms of the confusion. One of the reasons why they've never tampered with this law, they tried tampering and had to undo it retroactively, is because it's actually very difficult for the IRS to figure out how to, it's very challenging to know what the capital gains are from
how do you
to the next.
Yeah, Jonathan, how do you know the cost basis from the farm that was purchased in 1907, right?
Exactly.
So the challenge with this is that it really affects everybody, whether you have a $100 million estate or a $500,000 estate. This step up change could really affect almost everyone.
Yeah. I have to admit that this is the one thing that would fix that. Even though they had promised to only affect wealthier people, this comes closer to affecting everybody who, people who inherit houses and things like that. So I don't know if they'll go through. I don't, and then also the taxation of capital gains on non-sale gift transfers. Again, that's on the list. It's lower possibility, but again, anything's possible if they pass a large bill. For sure, the sophisticated estate plans. If you've done any sophisticated plans, meaning you've worked with attorneys, they've created trusts, things in Nevada or South Dakota or Alaska trusts, Dynasty Trust, or all these things that are out there that are very sophisticated, you will want to revisit those plans with your attorneys. Now, I just want things to consider. Again, these are just some of the basics. Number one, if you haven't used up your federal gift and state tax exemption, that's something to think about. Ryan, if you go over the state level exemption, you would pay your taxes. You would have to pay gift tax, for example. If in Washington State, let's say in Washington State, you decide to transfer $11.7 million to your children in a trust as a gift, you wouldn't pay any federal state or gift tax, but you could have to pay some Washington State level taxes.
No, it's my understanding you wouldn't. You're able to use that federal exemption to pass down gifts to your loved ones during life, and that would increase your taxable estate as well for Washington State. So that's a strategy a lot of folks use. Even towards end of life, you could make those gifts rather than through your estate during your life, even if it's a week before you pass away. And that's another kind of strategy that's used. It's really to be cognizant of those lifetime gifts.
Okay. Okay, so good. So are some strategies. These are things that if you have some unused federal exemption, and you have some and holding on to significant assets, you'll definitely want to talk to attorney, local counsel to make some transfers. How do you do it? How do you make sure you don't have to pay upfront any gift taxes? I mentioned you could utilize it's a use it or lose it, because if they reduce it, you won't. It's not like you've lost it. You've lost opportunity. The other thing, and again, I'm not an investment advisor, but it seems to me, and investment advisors have told me that they're also monitoring this very closely, and your investment advisors should have approaches to help rebalance portfolios. There may be changes, maybe moving away from let's say certain types of growth stock or dividend stock, maybe to tax-free bonds, value stock. I don't want to get into too much advising people on this because I myself don't know enough. But definitely investments that might have a longer term growth horizon. So delayed income, real estate, or life insurance, just ideas that are out there. Now, this is the point here: converting as much of the IRA and 401k and other retirement accounts into a Roth. You have to pay income tax on those transfers into your Roth, and that's usually goes against the grain. People usually don't like to do that. But the Roth IRA is a very special opportunity, because once you've got your money in a Roth IRA, the growth and the withdrawals are growth and withdrawals are all tax-free. So if you do it early enough, very, very significant tax savings. And I have a feeling that this will be one. Well, I just saw today that there's some talk about even stopping that. But assuming that the Roth IRA conversions are available, I have a feeling that if you can stomach paying some taxes, you're probably doing a lot for your family going forward. And once it's in that Roth IRA, it's just a matter of investing it and letting it grow for the next generation. So that's important. Ryan, did you have anything else on Roths? I know we discussed this.
Yeah, they're just super powerful. I mean, I think even for folks in your 50s, 60s, 70s, given that tax rates will never say never be lower or likely in our near future, take advantage of paying some of that tax now, getting a Roth, because the Roth will grow, and there's no limitation to your folks who inherited it either. So just a powerful tool to consider with your advisor.
Yeah. And like I said, I just saw today a discussion about basically stopping the rollover, basically preventing anybody earning over certain amounts from doing these rollovers. So it might be a limited time offer to be able to move assets into a Roth. Onto the charitable ideas. All right, so charitable into trust, charitable gift annuity. These are trusts that allow you to, I put as a cash in on appreciated stocks with no tax loss in principle. Essentially, you can move appreciated assets into either one of these vehicles without paying any capital gains. You create an income stream. It could be for life or it could be term of years. You could have some tax-free income if it's a gift annuity. And you can get a nice income tax deduction up front. And so these might become more and more powerful. Maybe Ron, you can discuss. You said you did one recently, and would give a good example for people.
Yeah. Thanks, Jonathan. So these have become more popular. I think a lot of folks and their advisors are talking about these solutions. And first of all, the charitable inclination is the first part. You have to be charitably inclined and want to make an impact for Swedish or another organization. But we're seeing more interest in talking to more folks about these. A recent example, we had a donor just this year who had a really good outcome and a good experience in the Heart and Vascular Institute here at Swedish, and was very grateful for their care. They really wanted to do something to give back. And we're talking about some different options. And he said, you know what? I think the remainder trust might be interesting. So in his situation, or their situation, they had $500,000 of appreciated stock. Let's call it Amazon. And the cost basis was $100,000. So they had $400,000 of taxable income if they were to sell those stocks. That could be up to $100,000 in tax bill for them. So instead, they took $500,000 into a charitable trust with Swedish managers. We pay them 7% income per year, so $35,000, which is tax advantage income stream as well, for the rest of their lives. So it's a really nice way to diversify. You get a stable income stream, and then on top of that, you get a tax deduction. Jonathan said they're getting $250,000 of tax deduction in 2021. And then the great part is that at the end, when the trust terminates, they're putting the money to work for a legacy for the Heart and Vascular Institute. So they're really powerful. We always kind of look for win-wins, gifts that fit within the family's planning, that also make a great impact at Swedish.
Yeah. I'm hoping if any of these changes happen, I have a feeling that charitable into trust and gift annuities in particular will become more relevant to people. And they've already been, and I've been working on them for my entire career essentially, but become even more important as an option. Because they'll be shutting down all the other options. So hopefully these will be available. Charitable lead trust is just another type of trust, but it's a very sophisticated trust that allows you to do a significant wealth transfer. You don't do these trusts for less than $1 million, usually many millions of dollars. It's transferred to heirs with a reduced gift tax valuation. Essentially, you could cancel out almost all the gift taxes or estate taxes, and you create a permanent stream of income, a fixed stream of income to charity. And at the end of the trust, of course, it goes to the family. And it could involve income tax deduction and some delay of capital gains. So again, it's a very valuable. One of the reasons I'm mentioning it, and I don't want to go too much. You can, if you have any interest in these ideas at all, please reach out to Ryan, and obviously you can reach. He has questions for me. You can always call me. But these are pretty standard, and he has information about them. But in the various proposals is taking out certain types of trusts that you won't be able to do anymore, but the charitable lead trust will still be available. So that will be maybe planners will turn to these vehicles Again, you have to create an income stream to charity, sometimes for 5, 10, or many more years. It could be longer. But the tax avoidance for the family side can be very, very significant. So something to think about. IRA rollovers. So IRA rollovers, charitable rollover, these are direct giving from your IRA. You have to be age 70 and a half. I always tell people you have to reach a half birthday. It's my own joke, but people laugh at me when I say this. No, I mean it. I get this question all the time. I said, tell the donor, wait, count 6 months and a day from your birthday, and then you can make the gift. So these are gifts directly out of your IRA. You can give up to $100,000 in any tax year to as many charities or one charity as you want. But it's $100,000 limit. You're not going to be taxed on the $100,000, and so therefore it's basically equivalent of an income tax deduction, because your IRA money is supposed to be taxed. So if you're no longer an itemizer, this is a really nice option for somebody, again, age 70 and a half and older. In fact, you could check with your accountant, but I think most accountants would agree. Oh yeah, if you're making charitable gifts, age 70 and a half and older, make them all out of your IRA directly to Swedish Foundation or any other charity that's a qualified charity, of course. Because again, you might not be getting tax benefits right now for charitable giving. These will be sort of double tax benefits. And actually, you can give actually up to your whatever your required minimum distribution is. Again, that only applies for age 72 and older. But if you're at that age, these also count for your required minimum distribution. So it could be a sort of tax savings. You don't have to pay tax on your RMDs because you're giving it to charity. Ryan, you had any more on IRA rollover giving and or beneficiary designations?
Yeah, thanks, Jonathan. Yeah, the IRAs your IRA is the tax bogey. I mean, both during your lifetime and passing assets on to children or loved ones. So they're perfect to give during your lifetime for the reason Jonathan mentioned. But when a lot of times folks come to me and they say, you know what, Ryan, like I have some kids, I want to take care of grandkids, but 20%, after everything's done, I want 20% to benefit Swedish, and I want to support the Cancer Institute. And so we say, the first thing we ask is, well, do you have an IRA? And the reason why is that, as Jonathan mentioned, the stretch IRA is that if you leave say it's $1 million IRA and you leave that balance to your kids, your loved ones, you have to take it out in 10 years. And if you're in the highest tax bracket, they could pay $370,000 in tax on that $1 million. And if you leave that all to Swedish, we can take the full million and put it to use at the Cancer Institute right away. If you then, in your planning, have stocks and real estate that's appreciated, as long as we have the step up in basis, Jonathan, then that comes to the kids or loved ones with the stepped up, and they don't have the taxes. So
Sure.
Quick tip, when you're thinking about charitable planning and including charity in your plans, really think about that IRA and give me a call. We're happy to help and discuss these options, but that's one of the best pieces of advice.
Yeah, and I see quite often that when I talk to individuals who work with, from my clients, I do see most of the time IRA beneficiary designations as a key feature in any charitable planning. So that's something you want to do in addition to IRA rollover giving, which is a nice bonus too. Gifts of appreciated stock or real estate. These are kind of interesting options. Again, these are straight gifts, but there's again a complete avoidance of capital gains if you send the stock or real estate directly to charity. You get a full fair market value income tax deduction, and you make a big impact today. So this is just something to keep in mind. If you're thinking about gift, for example, if you're thinking of just making a gift of, let's say, $2,000, and you have some stock that's appreciated, you might as well give the appreciated stock. You get the same income tax deduction, but you won't pay any capital gains on it. So that's just something that people aren't always aware of. That's an option out there. And obviously real estate's a little more complicated. You have to propose to charity. If you're thinking about donating real estate to a charity, you have to have a discussion with them, see if it meets their guidelines. But sometimes it can be very significant gifts also. Ryan, do you have anything on? I think you have anything on this, or we'll keep going.
Yeah, that's great advice. Let's try. We have a few more minutes. Let's try to move through those slides. Honestly.
Okay. All right. So here's the basics. I call it estate planning basics that never change. So the bottom line, and this is where I meet with individuals, what I find is that people wait too long. I know it's very easy to put off this planning. Nobody wants a plan for their own demise. But the reality is, the sooner you do it, the better. The sooner you have options. You wait too long, your options are limited, and sometimes you wait too long. And your lawyers like myself are dealing with the aftermath and issues. It creates lots of challenges for the family. So the main advice I give people is just try to organize your finances. Try to make sure that all the statements are in one place. If you're able to combine accounts, things like that, just to try to make it easier for somebody to help you when you're older, and then when you pass away, they'll know where everything is, and it won't be a big a situation to figure it out. The other issue is, I said, emergency caretakers. This is always an issue, and sometimes a lot of potential clients of mine, they're not sure that if they don't have a child who is available, or don't have children at all, they have to have somebody available who could help step in case of emergency or disability. You have to know where your documents are. We'll talk about documents in a second. And that's, and organizing your planning documents again. So I advise people to have a sort of a certain one location, a safe location where you keep your documents, and make sure that that person, who might be your executor or somebody step in with a power of attorney, they have to know where those documents are. They have to, and the last place you want to put them usually is, you don't want to put them in your safety deposit box, because the safety deposit box there might not be access to it. And actually, if somebody passes away, you have to get a court order to get access to a safety deposit box if someone's passed away. So that delays, that could be a very complicated situation. So again, you want to think about where your documents are, have them organized. The basics. Almost all the people I work with, almost always you do a will, which is, I don't have to define that. A power of attorney, which is essentially assigning somebody you trust who can step in and take care of financial matters for you. A living will, healthcare proxy. That's just, again, making decisions on end of life issues and picking who would be that person to help make those decisions if need be. And maybe sometimes some religious issues, you can put in some sort of clergy could be listed in there, someone to consult. And lastly, and this does sound like a small thing, beneficiary designations, but I have found that beneficiary designations is a huge issue. So I've learned through my own mistakes, but I haven't demanded of my clients to see their beneficiary designations. And then after they've passed away, I found out that they didn't take care of things. So that means that I've done lots of estate planning with individuals, but if a bulk of their estate is in a retirement account that has a beneficiary designation and they don't put the right person on it, it could be either a tax problem, meaning the entire retirement account be forced to be distributed and therefore taxed, or more likely just give it to the wrong person. So I had a family with 8 daughters, and I knew I was friendly with the family. I asked them, okay, where are your retirement accounts? Yes, I have one with the state. Great. Who's it designated? Oh, my oldest 2 daughters, I put it to them. I said, great. Well, it has to be designated so that all 8 get it equally. Sure, I'll take care of it. And I didn't follow up with him because, he said he would. I was with his daughter at the time. He didn't follow up with it. And for more than 10 years, the family was fighting over this because he left it all to one. Essentially, nobody else only 1 or 2 daughters got anything. So again, beneficiary designation so that your estate is not lopsided. So that's an unfortunate result that could happen. Now, I want to just mention, top 10 reasons to have a will or living trust. I didn't define living trust yet. Living trust is basically, I call it like a will substitute. They've been relatively popular as a way to reduce probate. They may still need to be required, to go through probate court a little bit, but a living trust does avoid that. But what's great about a living trust is that's a much more sophisticated planning that you're doing. You're taking a lot more attention. So I like to see people do living trusts, and I do them sometimes with my clients. I don't push them on people, but I do if it works for them, I do recommend it. But essentially, you want to have these documents in place because you want to decide how your estates can be distributed. Every state has different laws, so if you don't decide, Washington State has made the decision for you. That doesn't mean Washington State will take the money. I don't know, Ryan. Do you know how how an estate would pass, generally speaking, in Washington? Somebody passed away without a will?
Yeah, it's either going to find your succession of heirs and go down that way. But not always in the way that you'd like. And that's really the kind of the message is either you get to do it or the government gets to do it. Fortunately, Washington is a pretty fast and inexpensive probate state, but
Yeah.
they get to make the decisions. So
yeah. You want to make those decisions. Obviously, for those with minor children, you have to make, somebody has to make the decision. You want to put in who would be the guardian for minor children. You want to avoid, you don't want your family to go through a lengthy probate process. Again, I think they easily go 5 to 10 years, or even go on forever and never close. If there's potential state tax, obviously there's an opportunity to minimize some death after death taxes. If you're at those limits, you might want to do some charitable gifts in terms of charitable bequests. You want to pick who's going to wind up your affairs. Again, that's a hard decision if you don't have an obvious candidate. Usually it's a child, but if there's not a child who's available, that's a very big decision. And you got to look for somebody who you trust, who will take care of things. You might want to disinherit people. Again, sometimes things happen and the wills don't go through, and people you didn't want to inherit will inherit your estate. Get gifts and donations. Avoid more legal challenges, and your life circumstances do change. People do adjust their wills quite often. So sometimes, there are times I see wills which were signed 20 or 30 years ago, but quite often people every 3 or 4 years, as people get older, start looking at their estates, and so life circumstances change, and it's a good idea to review it, and you never know. So you want to take care of it.
Yeah,
here's my simple. Yeah, you have anything, Ryan?
Yeah, no, this is terrific. We're kind of pushing up against time, but I wanted to get to a question that came up. So they said for a charitable trust, you mentioned that someone used stock to set it up. Are there other assets you can use for this type of trust? The short answer is yes. Real estate's another good one. Rental real estate is great. Folks say, gosh, I've been managing properties for so long and I kind of want to get out of that. And, my kids don't want to do it. And so we can take highly appreciated real estate, fund the trust with that, and then turn that real estate rental income into diversified income stream. Again, you bypass the capital gains and get a big.
Yeah, you can. Well, it's really a complicated question, but at the end of the day, you can use real estate to fund the charitable into trust, which is a really nice, another great opportunity to create income stream for your life without that capital gains.
Well, Jonathan, we're pushing up against it, so I just wanted to kind of wrap up real quick. And if anybody has questions, real quick in the Q&A, shoot those in there. And just I'm a resource. The great thing about me or any of our colleagues at Swedish is we don't charge billable hours. So you can call us and ask questions. It's free. We want to thank everybody who is on this call for sticking with us. I know there's into the weeds a little bit on taxes, but Jonathan did a terrific job, and he's available as a resource as well. But we want to thank everybody for all the support, for those who give to Swedish or give of your time. It's really, really meaningful. I think a lot of people, the hospitals have all the money. But really, when it comes down to it, there are programs and initiatives we simply can't fund without philanthropy, and it's really because of you guys. So thank you so much for all your help. Jonathan, thanks again. Any closing remarks?
Well, there's your checklist. You can forward. People can get a copy of the presentation. And the main message I want to give everybody: if you're following the media and you're following the news and you're concerned about major changes, and I've sort of hinted to these things a little bit, I haven't gotten too much detail. Just my main message: don't do anything rash. We'll wait until the laws are passed, start and then follow up, see what's happened, and then meet with your attorneys. But don't wait till next year. If they pass a big infrastructure deal, you want to meet with your attorneys within the next couple of weeks, if you can get an appointment, because they're going to be very busy.
Yeah, thank you for that, Jonathan. I think the terrific point you made is just how important it is for all of us, whether we're 20, 40, 60, 80, to really think about our planning and take those initial steps, because it really is beneficial for everyone. So again, thank you all for your time. Really, really appreciate it. And please give me a call. Happy to help and talk through some charitable options that may fit your family and your planning really well, and also be able to make a huge impact here at Swedish. So thank you again for your time, and let me know if I can be of service.